The reason the Fed has already broken something, or else they wouldn't have needed to print $303 billion worth of cash. Prepare for a crash landing. TLT will surge to the moon, just like in 2008. This is not QE, and it definitely doesn't look like QT. It feels like they are panicking. It feels like they are hurting. It feels like they are yelling. We, the Fed, will print as much as you want. Don't stop running the banks. I can feel their excitement in their voice. They wanted more liquidity. They crave more. They couldn't get enough. So let it be known as quantitative teasing. What am I talking about? Well, there is a big spike in the Fed's balance sheet in 2020. As you may remember, the stock market rallied so sharp, most of us couldn't even buy enough stocks. Here is the spike this week. $300 billion freshly printed, just added into the Fed's balance sheet. Are we going to have a rally because of this? Or is this more bearish than people think? This spike is very similar to the spike October 1st, 2008. Are we just about to witness another financial crisis greater than 2008? I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back, everyone, to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore, you want it to be real, you want it to be true, you want to be my client, don't you? This is my client Eazzy's book, Wicked Pussy Perfume. This is my client's collaboration book, Adversity Equals Success. Get your copy today. They did QT to reduce their enormous balance sheet, to fight inflation. Now they just added more money on top. Erase 3-month progress in just a week. Stock did extremely well in 2020 case, but they did not perform well at all walking forward from October 1st, 2008. It was borrowing from the discount window. Well, the institutions just had to borrow from the discount window this week. What do you think is going to happen next? This is the S&P 500 up here. This is where it finished on March 9th of 2009. In terms of this recent spike of this liquidity, it really depends what the Fed does next. My last video, you may remember ECB raised rates by 50 basis points this week. It's possible the Fed is going to do some offsets that relative to this spike here. They could continue QT, they could increase QT. They could continue to raise rates, but if they don't do that, liquidity is liquidity, and this is relevant. It may impact market in a positive manner in the short term. The Fed also issued a statement. As always, the Federal Reserve stands ready to provide liquidity through the discount window to all eligible institutions. Borrowing at the Fed this week, $148.3 billion printed for net discount window borrowing. $11.9 billion printed for the new Bank Term Funding Program. Subtotal $160.2 billion printed. $142.8 billion printed for borrowing for banks seized by the FDIC. Total $303 billion. The market has dovishly adjusted to the banking crisis overhang, pricing in a peak in rate in May with just one 25 basis point hike, and then cuts for the rest of the year. Powell hikes continue to keep up its inflation-fighting efforts due to credibility concerns. I think that the inflationary policy is back in play with the Federal Reserve, putting money into the system through this lending program. In all the past recessions going back for decades, the yield curve starts de-inverting a few months before the recession. Adding that I think it's within 4 months at the most. Almost every indicator is flipped into high probability. The only one that hasn't is the unemployment rate. The Fed's aggressive rate hike cycle has led to cracks in the financial system. As the chart below demonstrates, history shows that the Fed's monetary tightening campaigns tends to have a negative impact on the world's financial system. As the U.S. central bank raises rates, things in the financial system start to break, often resulting in a crisis. We had the Latin American debt crisis of the 1980s, the long-term capital management hedge fund crisis in 1998, the tech bubble bursting in 2000, and the U.S. subprime housing crisis of 2007. In this case, U.S. regional banks have been under intense pressure since last week, following the swift closures of Silicon Valley Bank and Signature Bank. The second and third largest failures in U.S. history. Then came news that Credit Suisse may need a bailout after a major Saudi investor said it would not provide more capital to troubled Swiss lender due to regulatory issues. That forced the Swiss National Bank to step in on Thursday morning with a $54 billion lifeline to help shore up liquidity conditions. Banking sector turmoil continued Thursday afternoon after a group of the largest U.S. financial institutions, including J.P. Morgan Chase, Bank of America, Goldman Sachs, and Morgan Stanley, came to the rescue of embattled First Republic Bank in the form of $30 billion in uninsured deposits to help stabilize the lender. For those regional banks, they look like they are in the process of failing. In terms of some of these banks getting into trouble, the Fed told them in 2020 that they were going to keep rates low for a long time. This, buying 20-year treasuries, really didn't appear to be that risky at the time based on the Fed's promises. The headline from August 27 of 2020. Fed announces landmark policy shift to spur inflation. Job growth. Keep rates low for longer. What happened to that promise? Oh yeah, they lied to you. With president changed, inflation was exported from China and Russia so fast that makes your head spin. And here we are today. My take is that whatever the Fed does, it's a lose, damned if you do and damned if you don't situation. The U.S. central bank appears to be walking a tightrope, with the potential for a major policy error at each side. No change, 21.8% chance. If the Fed were to fold under pressure and keep rates unchanged next week due to strains in the financial sector, it would put into serious question its resolve to bring persistently high inflation back under control. Additionally, the damage to the central bank's credibility would be unprecedented, especially after Powell stated numerous times that rates would have to stay higher for longer to battle inflation. 25 basis point hike, 78.2% chance, while a quarter point move would make the most sense at this point in time. The fact that the Fed may relent on its previously hawkish stance would put policymakers in a tough spot, especially with inflation still running well above the central bank's 2% target. This too could leave the Fed at risk of easing policy just as inflationary pressures begin to reaccelerate. 50 basis point hike, 0% chance. A 50 basis point rate hike won't do the Fed much good either. With such an aggressive move likely to add to hard landing fears for the economy, consisting of the deep and prolonged recession. As such, the U.S. central bank would likely face criticism for making such a large move, considering signs of mounting stress in the banking sector. My personal inclination is that Powell and company will decide to raise rates by 25 basis points at the upcoming meeting and signal that further hikes are on hold for the time being. That would effectively end the Fed's year-long monetary tightening cycle, because the coming crash will be like after October 1st of 2008. Don't hold out hope for a mild downturn. As the U.S. economy looks set to suffer a severe recession, the Philly Fed's monthly survey of manufacturers, which recorded its 7th consecutive negative reading in March, more than 34% of the firms surveyed reported declines in activity, and both new orders and shipments hit their lowest levels since May of 2020. Philly Fed at a level that is 8 for 8 on the recession call, and with no head fakes. One added sign that Powell's finally drained the last ounce of punch out of the bowl. The fact that stocks didn't rally on Friday despite mounting expectations that the Feds won't hike interest rates this month. plus added $303 billion of liquidity in the system smacks of a crisis of confidence. As always, long-term investors should remain patient and alert to opportunity that will come once in a lifetime in a couple of months. You are such a good boy for watching my video right till the end. Bye.